As we begin our coverage of inventory costing for a manufacturer, we'll start here with job order costing. We will be studying cost accounting systems, and these are used to measure, record, and report product costs. So our emphasis will be on how we record direct material, direct labor, and manufacturing overhead for the manufacturing company. Now, the calculations here are very important because they're used in things like pricing decisions, product mix decisions, meaning which product lines will we offer, which ones will we emphasize, new product offerings, and financial reporting. Now, companies will put a lot of effort into accurately costing their products because it is critical to their success. A company really cannot understand their product profitability or accurately prepare financial statements if they don't have a good cost accounting system. Now, it is important to review that there are non-manufacturing costs, which, if you'll recall from our previous coverage, this would include selling and administrative expense or operating expenses, and these are expensed in the period incurred. This is true for the retailer or the manufacturer. Manufacturing costs, which include direct material, direct labor, and manufacturing overhead. Remember that these are recorded as an asset or inventory as incurred, and then expensed when the inventory is sold. Now, what we'll see is that the cost flow as we record them in the system parallels the physical flow of the materials as they go through the process to become finished products. Now, we need to compare actual versus normal costing. Actual costing would be a situation where you assign actual direct material used, actual direct labor cost, and actual manufacturing overhead cost to each unit. And that sounds logical. It sounds like what a company would do. But there is a problem. The problem lies with the manufacturing overhead costs. They are indirect cost of production that cannot be easily traced to each unit. And to further complicate things, they may not even be known at the time of production. Things like your utility bill will come in the following month, and you may have already produced and sold that inventory. So overhead does present some problems for us. In a normal costing system, you will assign actual direct material used and actual direct labor cost to each unit. And then you will assign an allocated share of the overhead cost to each unit. And we'll learn how to do that. Now, big picture, there are two basic cost accounting systems: job order costing and process costing. We're going to look first at job order costing. This is where costs are assigned to each job or a batch. If all of the units are the same in a batch, then we might just trace the cost to a given batch. A batch or a unit. An example of a unit might be a custom bike, a house, so a home builder will use job order costing, or an airplane. It could be a batch of units. 100 custom t-shirts. They would not trace the cost of producing one t-shirt at a time. They would trace the cost of producing the 100 t-shirts that, say, a student organization orders at the beginning of a academic year. 30 McDonald's kiosks. If McDonald's is going to open 10 new stores, they might order 30 of these kiosks that allow customers to self-order. These will be produced according to McDonald's specifications. So what is the key feature observed in all of these environments? A home builder, custom t-shirts, custom bike, or McDonald's self-ordering kiosks? The inventory is customized, or the products are highly differentiated. Right, in a job order cost system, we will measure cost for each job. We will use a job cost sheet to record the costs for each job, and we can easily calculate a cost per unit by adding up all of the product costs, direct materials, direct labor, and overhead allocated, and divide by the number of units in the job. Process costing is used when there's a large volume of similar products and we will accumulate costs for a specified time and then compute an average cost per unit for each department rather than each job. We'll study this in a later chapter. Examples: a cereal manufacturer, an oil refinery, or producer of paint. Now the paint, of course, this is talking about the base product paint, not the customized colors. When we talk about flow of cost for a manufacturer, you'll see that there are three types of inventory. So this is the thing that is different on the balance sheet for a retailer versus a manufacturer. A manufacturer will have not just one inventory called merchandise inventory, rather they'll have raw material, which is direct and indirect materials that have been purchased but not used. They'll have work in process inventory, that is inventory that is started into production but it's not yet completed. And then they'll have finished goods inventory, and this will represent inventory that's been completed but not sold. So this would be in the finished goods warehouse, ready to be sold. When we record product costs as they're incurred, we'll assign them to work in process inventory. Then when a job is completed, we'll transfer that cost to finished goods inventory. And finally, when the goods are sold, we'll transfer that to cost of goods sold. So this shows you what we mean by record as an asset as incurred and expense when sold. Now let's look at each of the costs individually. Direct material, this is assigned directly to each job based on the material requisition form. Now it's good to become familiar with the types of forms that you'll encounter when you get into the work world. A bill of materials shows the materials needed for a job, whereas a materials requisition form shows authorization to take materials from the storeroom and put them on the production line. Direct labor, these costs are assigned directly to each job as well based on the work tickets. So workers in the assembly line will have to record where they spend their time, which jobs they worked on in a given day. Now this will include the gross earnings, the payroll taxes, any fringe benefits that are offered to factory labor. Overhead. Now this gets a little bit tricky because it is an indirect cost of production. We're going to have to use an allocation process. And what we'll do is assign overhead applied or allocated to each job. We'll see this a little bit more clearly in just a few minutes. Now it is important to understand that the manufacturing overhead account will keep track of two things. So you will have a ledger account called manufacturing overhead, and it will keep track of actual overhead cost incurred and overhead cost assigned to inventory. And they may be, and very likely will be, two different amounts. Overhead applied is also called overhead assigned, overhead allocated. These terms all mean the same thing. Now we will assign an estimated amount of overhead cost to inventory by using a predetermined overhead rate. And I've highlighted the word predetermined. That's because it is established at the beginning of the period. It will be used throughout the period. and it should be based on an activity that causes overhead to be incurred. So you might use labor hours, and that would mean the more labor hours that are worked, the more electricity that is used, the more production supervisors we need, the more floor space that we need. And the form used to record the cost allocated to a given job is called the job cost sheet. That is one of the main things we will focus on in this chapter. And a job cost sheet, it's worth noting, will include any beginning cost incurred from a prior period, and you will add direct material used, direct labor, and overhead applied to get total cost for the job. Now, this assigning overhead cost to inventory is a three-step process. First, you calculate the predetermined overhead rate. We'll take our budgeted manufacturing overhead costs and divide by budgeted activity. Couple of notes about this. We can break it down into its fixed and variable components and then use the equation for a line to estimate the overhead rate for both parts, the variable and the fixed. Some companies will separate it, sometimes it will all be in one lump sum. It's also worth noting that you can calculate a plant-wide rate or one for each production department. So if you have a cutting department and an assembly department, you would calculate an overhead rate for each one. And there's really no difference in the formula. It's just that you will break overhead costs down by department, say for the cutting department, and then you'll divide by labor hours, and then you might have overhead costs for the assembly department divided by machine hours. And this just allows your products to be assigned overhead cost based on how much they utilize the resources of a given department. We'll see an example later in our lecture notes. So first, calculate the overhead rate. Second, throughout the period, overhead is applied to production through the work in process account based on actual activity. Your formula, overhead applied, is equal to predetermined overhead rate times actual activity. And then third, the overhead account is closed out to cost of goods sold at the end of the period. That is assuming that the amount is immaterial, which is what we'll always do in this course. So at the end of the period, it is likely that your actual overhead cost incurred will not equal the overhead cost assigned to inventory. Overhead is underapplied if actual costs are greater than applied cost, and it's overapplied if actual costs are less than applied overhead costs. When analyzing overhead, you may want to jot this in the margin. We often use the T account for overhead. We'll put actual overhead cost on the left side or debit side of the account and applied overhead cost on the right side or the credit side of the account. Then you can see if actual costs are greater than applied costs, we've underapplied overhead, and if applied costs are more than actual, we've overapplied overhead. With examples, this will, I think, become more clear. Let's look at a brief example. Alpha Omega Company applies manufacturing overhead based on labor hours. Assume the variable manufacturing overhead rate is 50 cents per direct labor hour. In addition, the total manufacturing overhead costs are expected to be $80,000 next year. To direct labor cost for 40,000 direct labor hours is expected to be 400,000 next year. During January, direct labor cost incurred totaled 45,000 for 3,000 direct labor hours worked. Actual overhead cost incurred totaled $8,000 for the month. It is important that you recognize that the first paragraph gives you an estimate of overhead costs for the year, and the second paragraph tells you what actually happened during the month of January, so just 1 month out of that year. Now the first thing we're asked to do is calculate the predetermined overhead rate, and I show you the useful information for calculating this. We have the variable overhead rate is 50 cents per direct labor hour, and we'll need to calculate the fixed overhead rate. Fixed overhead costs are expected to be $80,000. We're told that they apply overhead based on labor hours, so we'll divide by 40,000 labor hours. Notice that we know that 400,000 labor dollars are expected, but the company does not apply overhead based on labor dollars. They apply based on labor hours. The total manufacturing overhead rate is $2.50 per direct labor hour. So this means that this company believes that every time a labor hour is worked, they will pay the direct labor and they incur about $2.50 of factory rent, factory insurance, factory utilities, factory maintenance, etc. It is an estimate of the rate of incurrence of those overhead costs. The second thing we're asked to do is determine overhead allocated to production during January. Here is where we'll use our overhead applied formula. You'll recall that the overhead rate was calculated to be $2.50 per direct labor hour in Part 1. So overhead applied, we'll take that $2.50 and we'll multiply by actual activity. Since our rate is per labor hour, the activity we focus on is actual labor hours. We will apply or assign $7,500 of cost to inventory for overhead. The third thing we'll do, it says if actual overhead at the end of January is $8,000, did the company over or under apply overhead during the month? I'm going to set up our T account. I'll put actual overhead cost on the left side and applied overhead cost on the right side of the account. We see from what's given, we actually incurred $8,000 of overhead. We calculated the overhead applied to be $7,500. You can see that we have a $500 balance. Now let's pause to understand what this is telling us. Based on our overhead rate, we assigned $7,500 of overhead costs to inventory. At the end of the period, we find out we actually incurred $8,000. Since we incurred more cost than we assigned to inventory, we have a $500 balance that is underapplied. We have underassigned cost. So the last thing we'll look at, assume the manufacturing overhead account is closed out at the end of January and the balance in the account is immaterial. That means it's not a significant amount. Will the adjusting entry increase, decrease, or have no effect on cost of goods sold? If you have underassigned cost throughout the month of January, you will need to increase your cost of goods sold. The thing you're trying to do here is get your records right. So if you have underassigned cost throughout the month of January, you will need to increase your cost of goods sold to better reflect what actually happened. Now this is a good time to stop and review your notes. What we're going to do next is work a few different examples, and if you are familiar and understand what we've done up to this point, it really will be helpful. Tune back in soon.